Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
Welcome to the Pilot Money Guys, and we're super excited today to cover an awesome topic. We're going to get in the weeds today, Kevin, the Professor Gormley. We're going to talk about direct indexing and many other things and how that might be an advantage to our pilot tribe today. But we'd love to welcome Shawn Jaberzadeh to our show today from Dimensional Fund Advisors. And he's joining us from Los Angeles today. So Shawn, thank you so much for taking the time today to join us. We really appreciate it.
Yeah, really glad to be with you both.
Shawn works for Dimensional Fund Advisors. I think it's safe to say you're a vice president. In fact, I listened to another podcast.
Everybody's a vice president.
I know. I listened to another podcast you were on today, and they introduced you as that. But again, your time is very valuable. We really appreciate you coming to share some of your knowledge with our audience, and because it's a technical topic, and we're just now getting introduced to this, and so we're learning about it. So we're glad that you're here.
Yeah, Shawn. So if you just want to tell everybody what you do at Dimensional.
Yeah, I've been at Dimensional for 18 years. So it's been an extraordinary journey with a great organization. I co-head our enterprise group. And so you can imagine that being some of the largest registered investment advisors in the country. They typically span a lot of states with hundreds of employees. And our team basically supports them daily with things along the lines of what we work with your organization with, whether it be investment strategy, communication support, research. And so it's a really fun job, and glad to be with both of you to talk more about what you said, which is a really exciting topic in the direct indexing realm.
Charlie, he's from the A team is another way to say what he does. He works on the A team for sure. So we are excited to have you, Shawn. So I got really interested and fascinated with direct indexing, SMAs, and we're going to ask you to talk a little bit about that in a second. But I got really interested because every person that was reaching out to us to talk about new investing, they were talking about their direct indexing, and I saw a lot of stuff online about it. So, Shawn, can you kind of define what direct indexing is, and then go through how Dimensional might do it a little bit differently?
Yeah, absolutely, Kevin. And maybe before I define direct indexing, I'll take a step back.
Sure.
A part of this, and you guys have been in the business for some time, is also a little bit of marketing. And I'll tell you what I mean by that. So ultimately what we're talking about here is, as opposed to an investor investing $1 of their retirement money or wealth into a commingled solution, so a mutual fund or ETF, where they're basically in there with likely hundreds of thousands of other investors, and you kind of get what's prepackaged. So there's an idea that, well, not every investor needs to necessarily only be able to invest that way. So if you go back all the way to the 70s, that's when separately managed accounts first came on the scene. And the idea was that it was going to be separately managed for an individual. And that individual used to be pretty high net worth, because it had to be worth it for the organization to kind of do something, if you will, off the menu. And so there you had, in the same way that investments were done back then, a lot of conventional active management, right, where a portfolio manager would put together a group of securities, and then they would customize it for that investor, and then do some tax management, again, predicated on being a high net worth individual and wanting to mitigate the tax burden. Well, as both of you, I think, know, and hopefully your audience has a sense of this, the conventional active management wasn't the most consistent approach to investing. And as time went on, people said, okay, well, if we can't really perform well on expectation doing a conventional active approach, is there a different way? And that's when you get the advent of indexing and the amazing work that Jack Bogle did for some time, beginning in the late 70s and 80s. And there you have an idea where you say, okay, in the same way that a separately managed account was doing conventional active management, can we have essentially a separate account, but that just invests in the index, just like indexing would in a ETF or mutual fund? And the answer was yes. And so you had some organizations come out with separately managed accounts that would invest in a sampling of a particular index, like the S&P 500 or the Russell 1000 or the Russell 3000. And so direct indexing, that really has sparked, I would say, the imagination of investors and professionals alike in the last 5 years, is really a rebranding of that move from conventional active management in a separate account to something more like indexing. And the idea there, it's in the name, is you can directly invest in some of the securities that are a part of an index. And so that's how we got to where we are today. So does that help contextualize what direct indexing is?
Mm-hmm. Yeah, absolutely. So instead of investing in an exchange traded fund, ETF, or a mutual fund in the S&P 500, you could, I guess, invest in the underlying securities. Is that right? Is that
that's exactly right. And I know we'll get into it. There's definitely some benefits to investing in individual securities versus the commingled that you don't get the advantage of in a ETF, as you said, but there's also some drawbacks. And so we'll maybe go through some of the trade-offs of when it might make sense or when it may not.
Yeah. And just to add a little color to that, to me, it seems like if I wanted to, let's pretend I was going to do my own direct indexing, that I would go out and I'd buy 500 stocks and, about that in the S&P. I'd buy a couple thousand stocks to mimic this certain index or whatever. But that's just not practical. You know what I mean? So that's why an individual, and that's also probably why this has become more, applicable and available to the general investor, is that now we have some technology things that just wasn't practical. It's not practical for me as an individual to go buy thousands of individual stocks, think about rebalancing those things. And so to me, that's how I kind of think about direct indexing. Someone's doing that for me. And again, like you said, Shawn, we'll talk about the advantages and, pros and cons of that strategy here in a few minutes. But is that a very simplistic way to say that without oversimplifying anyway?
No, you're absolutely right. I mean, you hit on one of probably the three major reasons why direct indexing has elevated in the last 5 years, Charlie. So you've got the first one, which is advancements in technology. It is easier to do what you just described today than it was, frankly, 5, 6, 7, 8, 9, 10 years ago. Another one is actually trade costs. Just a few years ago, you had virtually all the major custodians take the trading costs on individual securities down to zero. Now, there's some exceptions to that, by the way, but for the sake of this conversation, I think that's fair. And so now, if there's not an additional cost to trading individual securities, that's another hurdle that you're taking off the table. And then finally, I think it was taxes, no matter where you are on the wealth spectrum, have continued to be a very hot topic. Some of it sometimes obviously politically driven. And so I think it's just top of mind for people. How can I save more anywhere in my life, including the burden of taxes that I have to pay? And so going back to the benefit of an individual security approach over a exchange traded fund approach is you get things like being able to carry forward any losses that might have been accumulated, given that you directly have ownership of the individual securities, as opposed to what might happen in an exchange traded fund. So what I mean by that is you can go from, let's say, January 1st of 2024 through December 31st of 2024. And let's say that the S&P 500 index, right, those baskets of 500 securities were positive. Okay, well, at the end of that year, if I'm an investor in an exchange traded fund of the S&P 500, there are no losses for me to realize, right? Because in that year, there was a full gain. Well, if you own all the individual securities, it is very unlikely that every one of those 500 individual securities were at a gain for the year. And it also doesn't mean that they were at a gain in different parts of the year. And so, and I know we'll get into this, but the individual security approach allows an investor to take advantage of times when there's losses of individual securities they own, and then they can start accumulating those losses, and then there's benefits to what you can use those losses for.
Yeah. John, I'm going to go out on a limb here. I don't usually make predictions, but I am going to make a prediction here. So my prediction is if all 500 companies in the S&P 500 are all up in a year, that we have a bubble. And Fama would say that bubbles don't exist, but I'm going to go out on a limb here and say that if all 500, so there's always going to be losses in almost any index in a year. And so what you're saying is
exactly right.
And we are heavy duty tax geeks. Our clients, their number one expense other than maybe an airplane, Charlie, is which most of them don't have, is taxes. So we are very focused on taxes. Our clients are very tax sensitive.
Yeah.
But let's take a step back here and just talk about the other reasons why we can do this now, and why it's kind of come down to clients like ours. What are the reasons for that?
Yeah, I would say, so first and foremost, I would say there's a difference in investing in something that's off the shelf versus one that feels like it's curated for you. So although as Charlie and you have mentioned, these are still technically early days, although there's been tremendous growth in the separately managed account or direct indexing space in the last 5 years. There's some early studies, if you will, that suggest investors can stick it out longer with a portfolio that they feel like they had a part in building than one that they just got off the shelf. So I do think in the benefit of long-term investing reinforcement, that's certainly one thing that's been cited. Another one is sometimes, and you just mentioned that you've got your pilot tribe, right? Well, there is always the idea of investing where if your clients invest in the S&P 500, well, whether they like it or not, they're going to get additional exposure to the industry that they're already getting a paycheck in. Maybe they got restricted stock units in. Maybe they got assets, to your point, that are tied to the industry. And so in a S&P 500 ETF, they're going to get whichever publicly traded companies are a part of that are in the aerospace or public transportation arena. In a separately managed account direct indexing space, you two, in consultation with your advisors, could actually go and carve out either the sub-industry that speaks to your client that they might want to kind of hedge against because they don't want to double, triple up relative to their exposure they naturally have, or they can go very specifically and exclude specific companies that they may not want to have in their portfolios. Now, that might fall under employee competitive covenants in their contracts. That might come in the fact that if they are sitting on the board of a company, they might have restrictions on which securities they can trade or when they can trade those. So it goes down to regulatory, compliance, and personal preference reasons. And when you look across all of the areas you can customize across the faith-based and values-based side of the field. You can customize across the industry, as I just mentioned. You can customize across the individual security approach. Even for some folks, I know you work with some executives that might be more attuned to corporate governance related topics. There's even corporate governance related things that they can screen out for. And so I think when you take all of that, you're giving a client and frankly their trusted advisor the opportunity to curate a portfolio that feels a lot more specific to their circumstances than just off the shelf. Now, by the way, and I know we'll get into this, off the shelf might be perfectly suitable and the right answer for some clients. And so I think the question of, well, when should someone consider maybe having a part of their portfolio be in a separately managed account direct indexing type solution? It's going to be when the tax piece comes in, which both you, Kevin, and Charlie mentioned, especially the tax sensitivity of your clients, right? So if a ETF has a gain, right? And I know that's not common, but there are ETFs that give gains. And if you have clients that own mutual funds, right, they might kick out gains. Well, the gain realization is out of their hands, meaning they don't have a say on when and how much of that gain is going to be realized. It's determined kind of for them, if you will. Well, in a separately managed account, hopefully there's gains, by the way. We don't want this thing to just worry about losses. We want it to grow over time. Now, if your client in consultation with you gets to decide then if, when, and to what magnitude do they realize the gain, taking into consideration everything else they've got going on in their investment portfolio that you're ultimately managing, both inside the portfolio as well as maybe outside the portfolio. And so I think those are some of the benefits when you start saying, okay, when should I consider a separately managed account? And I will say it shouldn't be the default answer, but I definitely think, especially given that you guys are so tied into what's going on in their tax lives, you're likely going to be really good stewards of when that might make sense more or less.
Yeah, I love, Shawn, you talked about And we'll sum this up in a second. Basically what I hear you saying is, hey, reason one might be that we can really tailor this direct indexing portfolio to exclude things that, like you said, maybe there's some faith-based screens, maybe there's some other, we want to exclude a certain country, a certain holding. So that gives us flexibility. We'll talk a bit more to that in a second. But the second big picture thing is the tax component. And I'll get Kevin in a minute to break down tax loss harvesting for us, just as a reminder. But basically, you talked about gain realization there. And a lot of mutual funds, just to give an example, one of our clients, good friends, has a mutual fund. He's kind of stuck in it for capital gains reasons. It would be a big tax bill. But every year within that fund, there is activity, trading activity. And as you said, there are gains recognized there, whether he likes it or not. So there's a tax bill there, whether he likes it or nobody likes a tax bill, but whether he, needs that or not, he pays a tax bill every year. And here's something that's even more maddening. Sometimes he pays a tax bill and the fund itself actually didn't increase that much. You know what I mean? There were
or lost money.
Yeah. So that's really frustrating. But let's see, one of the things I think, and we can focus on whichever one you all want or go back and revisit, because I love what you said as far as being able to tailor or have some personalization, skin in the game, if you will, in that direct indexing, is that the evidence shows you'll stick it out longer because you get to see the holdings. You have that emotional buy-in versus seeing some obscure title of an ETF or whatever. That's something I didn't think about. So that's really fascinating. But Kevin, what do you want to go back and talk about the values-based screens first, or reattack the taxes and going more in depth?
Well, I'd like to talk about my piece of IKEA furniture over here that I'm looking at right now that I built in New Jersey, 30 years ago, and it's made the trek to Memphis, to Oklahoma, now to Knoxville. And I think, the IKEA effect is a well-known behavioral finance effect that when you build something, it becomes something that you enjoy even more. And you don't want to get rid of. So I do appreciate what Shawn has said here with the direct indexing. Let me ask a little bit. So we know we're going to get into the tax benefits, but Shawn, who are the people? Like, pilots are listening right now. They're going about their day. They're listening. Who are the people that really should consider these separately managed accounts? And we'll get into how Dimensional Funds does those, or other direct indexing. Who are the people that really should consider it in your mind?
Yeah, so I think there's probably at least two buckets. One bucket is if you've got any clients or members in your audience who have concentrated positions in individual stocks that they may have inherited or built up over time, whether with you or before they got to meet you both. And we'll talk about that. Building around concentrated securities with exchange traded funds, very difficult. You likely will own more of what you actually don't want to own as much of anymore. And so diversifying through an individual security build while taking into account what they already own a lot of, but they're kind of locked in, if you will, because of the gain circumstance, one major reason. Second major reason we've already touched on, when there are real tax considerations relative to their circumstances. Do they have rental property that they might be kind of taking gains from? Well, if you have the ability to push on the tax loss work that happens inside of a portfolio, well, you can't guarantee it every year because it depends on what the market provides to you, an opportunity, and what the underlying securities are. But you'll have more opportunity to perhaps build some tax loss harvesting that then can offset those gains that are outside of the investment portfolio, such as in a rental property or other investments they've made. And then the third, I'd say, is the personalization piece we've talked about. Now, in my experience, it's uncommon for someone to launch a separately managed account direct indexing solution solely for the personalization piece. Usually there's an investment reason why they and their advisor want to get into one. And then the cherry on top is that they can curate it to feel a little closer to what they'd like it to be than just getting something off the shelf.
So getting back to the tax piece, which I think, again, many of our pilots, they fly with someone for a few days. Eventually, things come up about taxes, the government, whatever, and they stew on a little bit about paying too much tax because they get all their income from their company for the most part. So when you sell a capital investment, be it a stock, be it a rental property, whatever the case may be, a piece of land, that's in a different category than is your income from flying. And pilots, they know that you can only offset income by $3,000. So we're talking about a different classification. If you're thinking that you're on one track with your W-2 income, it's actually another track. It's capital asset taxation is really what we're talking about here. So what if I'm somebody that has a rental? Maybe I was living in one place. I went to another base. I have that house there. I decided to rent it, and I've rented it for 30 years. And now I'm going to sell it. So how would the direct index or the SMA actually help that person, Shawn, if you can go into that?
Yeah. So obviously we're speaking generalities, but I'll
Sure.
get into maybe what Dimensional does specifically here, because I think it is helpful. In Dimensional, we think that when you're launching a separately managed account with us, you get 3 bites of the tax apple. And so I'll get to what your kind of case was in a moment. There's one, like right when you're launching the account, it's usually unlikely that an investor just has a stack of cash waiting to launch it. It's usually they've got holdings and they're going to work those into this newly launched separately managed account, build around it with your advice, and then they're kind of off into the races. But at that transition, we give them several options based off of a spectrum of tax gain realization to get closer to where you believe they should be, given their risk tolerances and their goals and so forth. So that's the first bite of the apple at transition. The other bite of the tax apple is what we're just doing each and every day, depending on the tax management customization that you've selected on behalf of your client. So Dimensional actually offers 4. So it's not a one size fits all. There's a no tax management option for the assets in an IRA, as an example. There is light tax management. And as the name suggests, what that's doing is it's trying to drum up tax loss harvesting to begin to deconcentrate maybe one or more highly concentrated securities that have embedded gains. And then there's a standard tax management and then an aggressive tax management. And the difference between standard and aggressive, as the names might suggest, is that the work that we're doing to identify and realize losses to build up get more and more intense and magnified each and every day as Dimensional is doing the management. So now you've got the daily work that Dimensional is doing at that kind of tax puzzle, if you will. The third is where your situation comes in. You know your client is going to sell that property. You have an estimate of the gains they're going to realize. You call up Dimensional and you say, in Charlie's separately managed account, I see we've got $20,000 in losses already stacked up. That's wonderful. But my client's about to realize a $50,000 gain. Depending on what the market gives you, Dimensional, I want you to do your darndest to try to actually get to that 50,000 mark, because I want to offset as much of, if not all of that $50,000 gain I know we're planning on taking for our client. And so now then Dimensional all of a sudden has that as its goal. And if the next day, which is unlikely, of course, can give us all of that, we'll get there. Because now that's our first order principle for that client specific account. And so I think that speaks to the separately managed, right? We're not doing things in a one size fits all. It's going to be very curated and specific to what each of the clients might be dealing with and what you believe is in their best interest in terms of managing.
Yeah, that's a fantastic answer. I love it. Charlie?
Yeah, that's powerful. I love it because I was looking earlier today, and in the fourth quarter of 2021, the S&P, in fact, the S&P was up in 21. It was a great year, but in the fourth quarter, it was up almost 10%. But yet about 130 of the companies within the S&P showed losses. So you could, it's pretty amazing to have that flexibility and that benefit. So I love that example that you gave there. It's very practical.
Yeah, and actually, one of the portfolio managers that works on our separately managed account desk, this was for the year 2024, and I believe it was the 8th trading day of the year was the largest drawdown for the whole year. Mm-hmm. And if you think about why I'm mentioning that, so you mentioned the fourth quarter of 2021 and how many securities in that quarter. The reason I mention this is because I alluded to the fact that Dimensional works daily at this puzzle. And so if you have a separately managed account partner that does anything less than a daily evaluation and the ability to execute, you are running the risk of missed opportunities. Because if you do it monthly or bi-monthly or quarterly, well, what I always say is market volatility doesn't happen on a month or quarter end. It happens when it happens. And so you need, your manager to be there to kind of take full advantage of things as they opportunistically rise up. And so I think the way we've set up our platform allows us to hopefully have the least amount of missed opportunities.
Yeah, that's phenomenal. And I just want to, sometimes these concepts are challenging to follow and things. And so basically, it's kind of hard to remember or think about that we can sell securities at a loss because, again, a certain part of the S&P, as example, may be down. We can sell those at a loss. We can repurchase securities that are similar. There's some tax rules there, but we can still have an overall gain in the year. And so I think I just want to really restate that basic principle in that as we talk about losses and selling losses, there is doing this in a taxable account, a taxable brokerage account, we call it. It's very unique in that you still have a positive gain at the end of the year. So Kevin, anything to add to that as far as just the tax loss harvesting, principles anyway?
Yeah. Two words that everybody loves is free and guaranteed. So I know we'll get to the trade-offs in a second about that fact that, when you're doing something different, you're doing something different. It's not always free, and there are no guarantees about how much can be done, but we'll get into that as well. I want to ask you about foreign companies because as a tax geek, we know that owning foreign companies diversifies, but it also gets you a foreign tax credit, which is a dollar for dollar reduction. So when you pay foreign governments money, the companies inside the ETFs pay that, you get that back. Is that similar? Can you do foreign companies in an SMA, separately managed account? And what's the effect of that dividend deduction or credit?
So first, there's kind of two ways you can think about that. One, actually, even in a U.S. based strategy, if you just sample an index in a direct indexing style approach, you could have a few securities that actually have passive foreign income of embedded in the overall picture, which is not tax efficient. So Dimensional, as an example, makes sure that we remove those out of the picture. So we're always trying to drive towards the highest pre-tax return design before we even get into the robust tax management work that we do. Now, specific to investing in the non-US in a separately managed account world, there's a few considerations. One, you can only gain access through what are called American depository receipts or global depository receipts, or ADRs and GDRs. Now, without people needing to remember those acronyms, why am I mentioning that? When a company overseas has a common stock listing, it is an additional cost. You could call it administrative burden to also list as an ADR or GDR. Now, the reason they would want to do it is because they want to expand the opportunity set of investors all around the world that might be willing to invest in their companies, right? But not all companies, I would say, could afford to do that or manage that process. So what do you get? You get usually only the largest of companies that have the ability to offer an ADR or GDR version of their common stock in their main country. So you might have, at least for any of your listeners that are invested in a Dimensional international mutual fund or ETF, you'll look at ours and you'll see thousands of holdings. Well, it is not uncommon in a separately managed account to only be able to get a couple of hundred securities relative to 1,000. So the diversification is really different profile between a separately managed account, non-US, versus a mutual fund or ETF. So in my experience, I would say advisors are not as quick to offering a non-US separately managed account as they might be offering a US one. So that's one. And then the other part of it, I would say, is by virtue of the lower diversification, now you go back to something Charlie mentioned, which I'd love to get into if we have the time, which is, what are you trading off? Well, Charlie mentioned you might want to sell out of one security and you want to then invest in a similar security because of some of the IRS rules of not just pouring right back into the same security the next day. Well, if you have a dramatically lower number of securities in the non-US to invest in, you are then also lowering the opportunity of securities that you might be able to go into after a loss harvesting transaction you might do. And so we certainly have clients that launch non-US separate accounts, but we try to make sure we educate them about some of those trade-offs and considerations. And then finally, not all custodians offer the ADR and GDR trading for free. And so at some custodians, and this is evolving, so I'd rather keep it general for the sake of this podcast. At some custodians, you might have a $6 or $7 per trade cost for what are called over-the-counter ADRs. And so if you've got several hundred securities that are over-the-counter ADRs, your client might have an out-of-the-gate $1,000 bill to pay. And so I think advisors also take that cost-benefit analysis of whether they want to execute a non-US SMA or not. So people do it, but there's probably a few additional hurdles to cross over before you get there.
All right. Well, let's come back to free and guaranteed then in that case. So separately managed accounts, part of the reason why we think the time is now to at least think about these is costs have come down so much.
Yeah.
But the cost of actually running the separately managed account has come down, but there still are trade-offs. So how do you think about like what would be the after-tax return of an SMA versus using the index? How do you think about that, and what are the trade-offs of doing one versus the other?
So it's a really good question, and I think you two have worked with Dimensional for some time, so we don't like to provide false sense of precisions on anything because
Sure.
Your question is loaded with what are the specific assumptions underneath. So actually, Dimensional's co-CIO and global head of research, Sabina Rizova, wrote what I think is a wonderful paper for any of your pilots that are of the engineering minds might enjoy it.
Sure.
And she actually runs through a 3-decade simulation of tax management approaches. And the reason we do that is we like to provide a range of outcomes because we don't like to give a point estimate. We like to give range of estimates to say, like, given so many assumptions on the decade and how the markets performed in that decade, and whether you're in a light, standard, or aggressive tax management, how you disposed of your securities matters. Do they get a step up in basis after your passing? Do you liquidate them? Do you have outside gains at all, short-term or long-term? So she took all of those considerations and assumptions. She boiled them down into, I think, about 216 sensitivity analysis kind of estimate. And it was a range. It was a range between, like 0.25% of a value add to maybe, 1.5% and everything in between. And so is there a value in an individual approach to tax management when you've got concentrated securities or higher tax sensitivity where the advisor and the client want to control the timing and magnitude and want to have an offsetting opportunity for outside gains? The answer is yes. What the magnitude of that is, it depends on so many things of when the client begins to invest, what they're kind of coming in with. And so I think the range is probably what we're more comfortable speaking about than a point precision, but hopefully that's helpful to your audience.
Yeah, no, I think that's great, and that's always a frustration when you ask about something that has no answer, is that you're still wishing for a number, and there is no number. If markets are good in certain decades, if certain stocks outperform others, it can really change the tax loss harvesting. Yeah. But as far as the drawback of like returns. And that's why I said it might not be free, is that you might have lower returns in some years than a benchmark. Any thoughts about that?
Yeah, I mean, I'll say you could have lower or higher.
Sure.
So let's get into, actually, we can go back to maybe the 3 buckets of investment approach that you could take even in a separate account direct indexing type of wrapper. Conventional active management is giving you, let's keep using the S&P 500 as an example. They're going to give you maybe several dozen stocks that they believe are going to be the highest flyers, right? And you might have some winners in there, but at least the academic evidence as well as the practical industry evidence has suggested there's a lot of inconsistency with conventional active management, and they tend to have a very hard time matching or beating the benchmarks that they'd be compared to, right? Because they're taking an opportunity set of 500, they're selecting 50, but do they select the right 50 at the right weights, right? So they could have picked a security that was one of the highest flyers in the entire S&P 500 index, if they didn't give that security enough weight, it doesn't actually materialize to an advantage for your client's portfolio in that year or for the long term. So then let's shift to indexing. Well, indexing, interestingly enough, Kevin, indexing is matching the index's return on expectation, but then there's some fees and costs. And by the way, indexing is great. They've got low fees and costs associated with them. But on expectation, you expect to underperform the benchmark almost each and every time just by the very nature of index funds. So if this is an index performance relative expectation conversation, you can actually consider yourself almost always ensuring underperformance there. And then with a different approach like dimensional, which, I'm not sure what you and Charlie call it, but, folks call it systematic, active, or evidence-based investing or factor-based investing. Talking about marketing, and we weren't a part of this, but it was called smart beta a few years ago, if you guys remember that.
Yep.
It's this idea that let's not just take what the index companies are giving us, those securities we need to own and at what weights. Let's look at that universe, but let's decide which securities we want to own a little bit more of and which securities we want to own a little bit less of. And let's be sure at Dimensional, we're doing that work every single day so that we're giving the client the highest probability of outperformance relative to decades of empirical research that suggests there are differences in stock returns. And you can harness those differences to create, with the help of an advisor's asset allocation, higher probabilities of earning on expectation and on average higher returns than just sticking in an index, right? Now, Kevin, you're absolutely right. Time period specific fluctuations will happen, but we're talking about kind of as a long-term investor, there are things you can improve to improve the outcomes that you might expect from investing.
Yeah, I was just thinking the phrase that we always hear is tracking error. And I'm amazed at that phrase, and our audience doesn't use that language.
Right.
But we do, because we think about what everybody sees, and this is kind of what you're talking to, Shawn. Everybody sees that headline number, and sometimes you're going to be different than that headline number, and that's okay. Nobody complains about being above that headline number.
Right.
But sometimes you're on both sides of that, and so I think that's where, and you may have even said it earlier, where the expectation management is really important. Like these are great strategies, but it's going to be a little different, and clients need to be.
I agree with you. It's interesting that I've always thought that the error part of that label was a misnomer, because you're right. You can error on the positive side, and clients never call you on the positive tracking error. It's only on the negative side. So we actually, because of that reason, but also a more practical reason, we even look at it differently at Dimensional, where we're not trying to solve for tracking error, because you're right. Clients don't know what it is on a top 5 list of things they care about. It's not going to show up. So we actually look at overlap. How similar or different does your portfolio look, your separately managed account, than what the advisor believes you need to get to? Because usually there's a goal that the advisor has of taking what you've got and managing that to something that they believe can be an improved portfolio, and then also an overlap relative to the benchmark. So we actually give a number of data lenses. And look, I think, hopefully this resonates with your audience. They've got a ton of measurement tools sitting in front of them in the cockpit, right? Because it's likely that they don't want to just use one measurement to make perhaps a decision, but they want to use a myriad of measurements to kind of come out with maybe the right next step or maneuver. And so I think Dimensional thinks in a very engineering mindset as well, where we're trying to balance between the return profile of what we're building, the tax situation, the costs, and the diversification. And the nice thing is a lot of those things in the way that our platform was built are levers that the advisor gets to pull on depending on what they know very well with the client. And that's what I've always loved. I've been at Dimensional 18 years, and we've partnered with registered investment advisors for about 30 some odd years of that. And Dimensional fancies itself the expert in capital markets and engineering the best tools that it can, but we're not the experts with clients. You guys are. And so we love that connection point where the advisor is the expert in the client. You guys are the main chefs, and we're making hopefully the best ingredients that you feel confident about putting all together for them.
Yeah. Charlie, it's been a few years since I heard boom, a new analogy that relates to flying with investing. And that was new. That was new. I hadn't heard that one before.
I had another one, by the way, for you, but I didn't.
Yeah, throw it out there. Go ahead.
Well, it was the tax. So, your selling a rental property after 30 years and your client might have a gain. I was thinking about how maybe in a particular flying circumstance, and Charlie will have to confirm this or deny this, but putting on the afterburners, right? Like you need something quite specific in that particular circumstance. And if you don't have that tool at your disposal, well, then you might not have as good of a flight option as you would otherwise.
Oh, that's a good one.
Charlie, use the hands, man. Use the hands. Tell us. Tell us.
I'll talk with the hands, but half of our pilot audience will make fun of me, and the other half will love it, because it depends on what you flew.
That's all he's going for.
No, that's a great analogy. I love it. It's always fun to say light the afterburner, no matter who you are, just light the afterburner.
Afterburner just sounds really cool, right?
That's right.
So we care very much about our pilot audience, even ones that don't work with us. Pilots have a very defined career, time that they can invest, and we also just want to help the community not make bad decisions. So who are the people that this is not a good solution for? Like, is there anybody that you could mention that is listening to the podcast? If your situation is this, then really, if your uncle starts selling direct indexing and other SMAs, it comes to you, you can say no because of why?
If you don't have concentrated securities that you're trying to manage around, you might not need to look at it. You likely have pilot clients or audience members who are retired. And so income comes down quite a bit, which means that the tax consequence of bracket they're in would come down depending on their state or federal circumstances. Sure. So if taxes are not a heightened sensitivity or burden, well then ETFs or exchange traded funds are very tax efficient tools that I know your firm's already using. And so there may not be an additional need to do much. And if there isn't a burning desire to personalize the portfolio across the faith or particular preferences and what a client really seems to care about, also not a good reason to have to step into a separately managed account direct indexing option. So I think there are good reasons, but I love the fact that you guys are always trying to level set with your clients, that the default isn't you need one. It's if you have particular circumstances, we should consider whether it's right for your situation.
Yeah. Shawn, you may have mentioned this on another one, or we talked about it previously, but sometimes people, they want to get, they want to get crazy. They want to get not crazy, but creative, or let's pick this, let's exclude that. And sometimes those invite people to maybe do too much, a little bit too much as well. So I think that's something to watch out for. In other words, it could boil down just to active stock picking if somebody, really wants to go for it and get crazy about it. So that's what we would avoid.
I agree. And this was a few years ago, and I don't know if you guys remember this, but there was this a really simplistic illustration, and it was supposed to try to emulate the average investor. And it was like, when you don't know much, you might go conventional active management because you don't know anybody. You just want to pick and choose and what company's on the billboard or what did you hear about from CNBC or whatever. You learn some and something, and you start like, okay, that might not be the most consistent long-term high probability success approach. So I'm going to do something different, right? And maybe indexing or a factor evidence-based approach kind of comes in. Sometimes people learn too much and they revert back to thinking that they're smarter than the average investor and they want to start tinkering again. So I think that's why it's wonderful having fiduciary-minded independent advisors in the mix. I've always said, whether you're actually a licensed therapist or psychologist or not, you are essentially acting as that. You're keeping clients away from themselves, like, kind of harming themselves, because, we're not naturally meant to be good investors, right? You tell someone what to do when they see a bear in the forest and they do the exact opposite. They want to run, even though you tell them, no, you want to stand there and stare at them and make sure you make some noise. So our human nature is that we want to be above average. We want to tinker. We think activity equals progress, but it's usually the exact opposite, right? The lack of sexiness or the lack of tinkering is actually what puts you in a better spot for long-term success.
Yeah, and it's amazing to me how much more humble Charlie is now after understanding investing. Yeah. So we all are humbled. And me too. I mean, we're all humbled by investment markets and the ways to do things, because there's so many ideas and so many ways to do things, and 98% of them are bad, but they sound great. So
they sound great. That's right.
Yeah, they sound great.
I love what you said, Shawn, and we're big fans of that discipline that it takes instead of the sexiness, and that behavioral, those behavioral biases creep in for us. So we love what you said there, and it's right on, and has a huge impact in our success. Well, Shawn, man, we really appreciate you spending some time with us today. We know your time is valuable, and I know I learned a lot. Your perspective is really, really valuable. So thanks for sharing that with our pilot audience. I know too that you've got a lot of interesting hobbies. You love basketball. I think you said you're a basketball coach to your at least two of the three kids, right? 11, 9, and 7.
All three.
All three of them.
All three, my two boys and my daughter. So we got 11, 9, and 7-year-old, and we got actually a championship game tonight for the 9-year-old. So we'll see if we can bring it home.
That is awesome. Awesome. So, we typically give all of our guests on our show a call sign. So, one of the things I was thinking about, you're also an MMA fighter, I believe you said. So you've got lots of skill sets. We're not going to go down the MMA fighter route. I'm not as familiar with that, but I know you're out in LA. You're a great basketball coach to your kids. And so I started thinking, who is my favorite Laker? So I don't know if you're open to it, Kevin. You can second or go a different direction. But I'm thinking, the work you do in the space of investing, the basketball coach, Los Angeles. I'm thinking about Magic Johnson, one of my favorite. So Shawn Magic Jaberzadeh, it might go. What do you think about that?
I like it. I used to see him around.
No kidding.
He used to host a big community barbecue at a park that I used to grow up playing basketball in. So we used to see him from afar. So I love it. I'll take it.
All right. It's awesome.
Charlie, I had another idea, but it's not as good as yours. Good work, man. It's Magic. Thank you. Thank you, Magic.
Yeah.
Charlie, Kevin, it was a pleasure. It was a lot of fun.
Awesome. Thank you so much. And we appreciate it. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.